Welcome to TheoTrade. This is Don Kaufman. March 23rd, 2022. We are 25 minutes after the cash close here on this Wednesday afternoon, just asking the question, are the bears back? S&P's closing down 1.3%. The Nasdaq right in line with it, 1.3% decline. But why question? Why question are the bears back? For that, you're going to be looking at volatility, which I'm going to take you in depth in just a moment to. All right, before we get to volatility, a lot of today's sell side activity, you can start to point some fingers. One of the first ones that maybe is just off the beaten path a little bit, take a look at the movement to the upside in the bonds. The bonds today staged kind of a wicked rally after what has just been hideous sell-side activity. And this unto itself, again, that sell-side activity leading to this huge bounce back in bonds, but that unto itself, the bonds, like from that sell-off to the huge rip your face off rally, that alone can actually account for much of the sell-side activity today. And you go, well, how is that? Well, it's simply due to the fact that the financials, they got crushed. Again, think about the relationship here. And that's what's one of the most critical aspects of today's marketplace. Like, look beyond, the obvious. All right, the S&Ps are down, 1.25%. The Nasdaq is off. Look to the fact that the rally in the bonds, right? What does that do? Well, it takes interest rates, which is the TNX, and pulls them back. Now, the financials love higher interest rates. Today, interest rates pulled back. The second that those rates pulled back, what did you get? The financials got crushed. Now, the financials got crushed to the tune of 1.85%. Let's go ahead once again and bring up the financials and do this with auto expected moves. The financials broke to the upside early in the week. Big fade. I mean, we're effectively now down on the week in the financials. That, in very large part, caused some of the sell side activity, okay, and was really persistent on the sell side to the S&Ps. It kind of felt like a lot of the Nasdaq stocks just basically followed suit. And the reason I'm bringing you into this, and again, I'm actually going to bring up the QQQ in terms of auto expected moves. The Qs, I mean, the Nasdaq hit the upper edge of the expected move, okay, yesterday, hit it again this morning, and then pulled back dramatically. All right, we are talking about some pretty substantial volatility specific to the Nasdaq, but I'm going to tell you right now, it was not Nasdaq stocks, including, stuff like Microsoft, which was, down throughout the morning, but it had rallied back. It was not Nasdaq leading the sell side activity. One of the things that's very apparent, and you really appropriately want to be able to pull out of the marketplace, is where did the sell side, persist? And interestingly enough, the sell side, well, it was all about, of course, the financials. Nevertheless, it was the rally in the bonds, though, that sparked that. All right, so push that aside for just a second. Another rather deep concern for markets, really, in this day of trade, you can't go any further than looking at oil. But the move in oil had really transpired before kind of the cash open even really happening. I mean, oil was up substantially kind of before the morning bell even went off. And again, I want you to see oil, it's on a tear. I mean, we're looking at almost 115 a barrel. And to me, there's just no question that that is going to dampen some of the spirits of the marketplace as a whole. But with all due respect, oil has been ripping the last couple of trading sessions. Today, though, I mean, it's just a standout because how many days in a row can you see 4 and 5% up moves, on a barrel of oil before it caves the S&Ps in? And, interestingly enough on this front, oil being up, actually took the energy sector and it rallied along with it. So I think the ironic portion of today's trade, and trying to answer that question, are the bears back? Again, with $115, oil, all of a sudden the energy sector is rallying. You almost have to look at that. It was a positive influence to the S&Ps today. And yes, the S&P still closed down 1.25%, but it was still positive influence was the energy sector. Nevertheless, okay, this has to be consideration to the days to come. If oil continues any upward momentum, that is it. It is over, people. This is inflation running amok inside of the marketplace, and it really starts to, again, cave the S&Ps in deeply. But, again, that didn't seem to have any negative impact to the marketplace in terms of, the energy sector pricing higher. Again, it's me saying that, strictly an opinion, a little anecdotal, that at some point along the way to the upside over here, that would be it for the S&Ps. Nevertheless, I think most would probably agree with that. So bonds, okay, are the predominant mover. Oil is a critical concern, okay? At that point, I think it's also imperative to look at the dollar. The dollar, it didn't really play much of a role. Lately, I've talked extensively about the fact that, the dollar breaking to the upside. Dollar has kind of become, if you will, like the new volatility indicator. And that is when, the proverbial crap is hitting the fan out there in the markets, that trade all over the world dives into the US dollar. It might not be the greatest place, okay, but it's better than what? The euro. It's better than, where else are you going to go? The Chinese yuan? It doesn't pay to use any other currency. So people are shoving capital into the dollar when there's real fear. What I can say about this is not real fear. For the most part, the dollar ended up massively unchanged on the trading day. So again, on one hand, the bonds are actually rallying. It's taken down the marketplace, but it's not a sign of the bear per se coming back. Obviously, oil becomes a concern. All right, moving on from there, I would be remiss not to mention volatility. Okay, this to me, it just doesn't look right. And when I look at the volatility futures, that's fine. If you want to be into the VIX, that's fine too. When I say it doesn't look right, if the bears are going to come raging back into this marketplace, shouldn't we see volatility ascend? This, okay, is absolutely nothing. Now, there's no question that the volatility futures are still in a highly guarded stance. And when I say that, I simply mean in respect to, what they term as contango and backwardation. So if you take a look at the April volatility futures, the trading, and take a look here with me at 25.15. The next series out is 25.94. There's still some distance, and this is absolutely contango. There's some distance between the Aprils, the Mays, and the Junes, but it's definitely tighter. So again, with all due respect, volatility did not come raging back. All right. To further that, the VVIX, that's the volatility index, it's actually sitting just south of the 110 region. It's not in what we term the VAMA zone. In fact, none of the volatility indicators moved. Okay. The other front over here, though, well, you did see some price action in gold back to the upside, but that doesn't exactly look like fear and loathing. So at this point in time, you're just crossed through halfway point of the week, and really it's the first selling we've seen, real selling we've seen in quite some time. But it does have the makings, if you will, of turning back into the bearish beast that it was just a little over a week ago. But where you want to focus on, unequivocally, it's not so much anymore the bond market. Okay. At this point and moving into the remainder of the week, it's got to be volatility. Okay. If there's one thing that you want to really focus on, like Thursday, Friday, watch volatility, specifically the volatility futures. If we're going to go back into a full-blown fit of rage in this marketplace, the volatility futures, they're going to wear that like a badge of honor at this point. Okay. What is absolutely, okay, pivotal here is that, yeah, if we turned around at this point and we started to sell back off, the initial sell-off doesn't have to be met with extreme amounts of volatility. Okay, but any further sell side activity, yeah, that volatility is going to come back up. So why wouldn't the volatility come up immediately? Simply in respect to the fact that we've seen this movie before. And I say that time and again, we've seen some volatility. The market has seen the face, okay, of the beast. It is not afraid. It will be afraid, though, if there's 2 or 3 back-to-back days of, sell side hitting that marketplace. Again, obviously, oil plays a critical role. Now, last but definitely not least, let's bring up the SPX, the mother of all products. So inside of the SPX, there's a little over $100 expected move, okay, on the week. Where are we thus far on the week? And the answer is completely and totally unchanged. So one of the aspects I will also bring to your attention is simply, okay, that there is a huge amount of movement that can absolutely occur in the next 2 days of trade. I mean, again, where are you on the week? Unchanged. We had to go a lot of everywhere to get absolutely nowhere. At this point, well, I don't know if the bears are per se back in town, but I can tell you that the rally is completely stalled out. I can also tell you unequivocally the expected move is equivalent to about $106. So put on your big boy pants the next couple of days. The volatility does appear, okay, to kind of be turning the corner and coming raging back. Again, it's all about the volatility indicators themselves, okay? That VVIX, the VIX, the volatility futures, they're going to tell us a tremendous amount in the days to come. Thanks, everybody, for joining us here at TheoTrade. Have a wonderful evening. Bye-bye.